Good morning, everybody. Welcome back to Schwab Coaching. It's our Tuesday edition of Trader Talk in today's market. I am your host, Kevin Horner, joining you from a snowy, chilly, cold Denver, Colorado. Thank you all for joining me today. Plenty to get to with all of you, and I'm pleased to do so today with my friend Brent Morris, who is in the chat. So I will be hosting the show solo, as is often the case here on Tuesdays, and we will then be getting to plenty of market discussion, some broad market look, obviously some sector action, many individual stocks in the news today. And because it is solo day, we're going to take the opportunity to maybe place a few example trades based on some of these recent upgrades, downgrades, and I want to solicit your input on that. So from an example standpoint today, we'll be building transactions that are going to be what you guys are kind of interested in after we go through some of these stocks in the news. So lots to get to, and I'm kind of excited to do it. I always love having you all join me. I see plenty of familiar names and faces in the chat here. So good morning to all of you. Take a moment if you're not already doing so. Please follow me and Brent on X, Brent Moores CS and Kevin Horner CS. We try to post there for you throughout the week, give you things to be aware of, things to keep an eye on. Just yesterday, of course, posted for you the earnings expectations for this week. Reminder, of course, that Thursday is a national day of mourning and the market will be closed for former President Jimmy Carter. So be aware of all that and just take a moment to follow us on X if you're not already doing so. Additionally, if you like today's discussion, the content we offer you, a big help to me would be clicking that thumbs up button down below. Also, make sure you're subscribed to the Schwab YouTube coaching channel. That helps us out quite a bit. So with that, let's get to the disclosure so that we can get to the fun stuff for you all. First and foremost, remember that our discussion here is exclusively informational and educational. What we mean by that is we do not make recommendations nor endorsements for any particular approach or strategy to trading the market. Remember as well that while we cover technical analysis here, we provide you with the insights that traders might consider when building their trades. But again, these are just concepts and strategies that might be employed. From the technical aspect, we encourage you to base decisions off a multitude of factors rather than any one specific thing. And certainly don't base decisions exclusively off of what you see from the charts alone. All right. Last note. Remember, we always work in the desktop version of the Thinkorswim platform, but more specifically, a paper money version of the desktop Thinkorswim platform. We encourage you to place your transactions and the decisions you make utilizing live platforms. Though the paper money is an excellent way to get acquainted with a particular strategy or get familiar with the Thinkorswim desktop application. But beyond that, we certainly want you to make decisions based on what is considered live data. So make sure you're doing that as well. Okay, so here's our agenda. Standard stuff, everybody. Same new year, but the same approach. We start that top-down view. We always start broadly. We'll look at the S&P 500, the NASDAQ 100, the Russell 2000, and we'll also bring the semiconductors into the mix. Had a wonderful day yesterday in the semis. Nice to see. It's been a bit of a shift for us. So let's get right to it, everybody. Let's bring up the chart of that S&P 500. And yes, we had a good day yesterday, but I am curious to know how many of you looked at yesterday's price action and said, hey, that's all well and good, Kev. I feel good on a Monday. Love seeing a follow through from Friday. Why are we not so excited about it? Well, I think if you are a technician and you watch price action, you are waiting still for some key development to happen here in the S&P 500, and that is a close above that white downtrend line off the 6,100 peak that we had back here in early December. We have yet to accomplish that, and so while yesterday may feel good because we are up at one point, if we just took a look from the trough here, the absolute low was 58.29 and a half, so just about 58.30, and then we rallied all the way to 6,021 yesterday. So if we just do a little quick math on this with my cheat code, my line, and move up to 6,021, we see that very quickly, 3 days popped 3.25%, and yet we did not break out yet. So wonderful move. We're pleased by the bounce, but we haven't yet closed above the downtrend line. And for many traders, that's going to be the key component. Can we get a close over the downtrend line? Now, even a rejection at the downtrend line today, that might lead us to dabble around the 50-day moving average or move a little bit sideways, but not necessarily pull back to these lows we've seen in here. I mean, essentially, we're just sandwiched between that downtrend line and the horizontal support evidenced by my white triangle down below. So really, if you're not certain one way or the other, let's say that you've been cautious heading into the new year, have not deployed new funds. You might not, as of yet, have reasons to do so just at this point, right? Because we've not gotten a true breakout. Yesterday's price action was good, but we have a lengthy tail. As you can see, we traded all the way up to that 6,021 level and managed to close at 59.75. So as good a day as it was, we did not finish at the high. We did not hold the move. And so look for some kind of confirmation here, I think is where the bulls kind of reside today. Need to get some confirmation, need to break out, need a close above that downtrend line to kind of validate the continuation of this excellent, it's been about a 2-year bull market move, if I'm not mistaken. Let's just take a peek here, rather. Go back to some of our recent longer range moves. When we took out the all-time peaks back here from the December of 21 window, once we took those out, yeah, our pullbacks have been very limited in scope, everybody. And in fact, I think we could probably suggest that off of this October of 23 bottom, we've been looking at a bull market since. And the reason I say that is because our pullbacks off of the peaks to the moving averages have been very limited. This peak pullback here was about somewhere in the neighborhood of 6%. This one got a little deeper, closer to 10. But remember, these pullbacks are common most often. Maybe not common in the last 2 years, obviously, right? We will frequently get 5 to 7% pullbacks, even the 10% drawdown in what we refer to as simply correction moves, as opposed to breakdowns, for example, or shifts to bear markets. Remember, very generic terminology here. 10% pullback, correction mode. 20% pullback and beyond leads you into bear market situations. As you can see, all the way back to that October of 2023 bottom, we have not had a pullback deeper than 10%. So really what we've seen is a consistent grind higher over that entire window of time, somewhere right now in the neighborhood of, well, I guess this would be a pretty decent healthy pullback, right? That was a little more like 11%. But in all honesty, everybody, we've really been in a bull market back to October of 22 because we've not seen that deeper pullback in the neighborhood of 20%. So real positive, real awesome. We like what we see from the bullish standpoint. But in terms of continuation, haven't yet seen it on that daily chart here. So if you're a longer term investor who's simply allowing the market to do what it's going to do, what we really want to monitor is that 20-week moving average. Can we continue to utilize it, or do we eventually find ourselves testing this 40-week down below, which in the last couple of years really has only been tested the one time since October of 23. So really nice look to the S&P 500. Let's hope we get the breakout here this week. As you can see, we're just right on that trend line. So how about the NASDAQ, everybody? Let's peek in here. We're a little bit weak today, but the difference is we actually closed above that downtrend line that I drew in. And of course, a downtrend line is a manually drawn line. So let's not assign too much detail to it or too much importance to it. But nonetheless, it's nice to see. If I zoom in, what we can note here is not only did we close above the downtrend line, we captured and held the 20-day. We're holding the 20-day at this moment as well. So our short-term trend analysis suggests that we've got potential for maybe the continuation move from here. But some of you are probably waiting for a little bit more confirmation. If today is day 2 of having broken the downtrend line, when we might be setting up opportunity for the trader who has been a little more cautious, right? Many of you will incorporate that so-called Horner rule and suggest that you want to see 3 consecutive closes over the downtrend line. Maybe you want to see 3 consecutive closes with holds of the 20-day moving average. That could provide traders a little more comfort here as well. In the only other thing that kind of stands out to the bullish trader who might want to place new money into this market at this point on the NASDAQ 100 is that you might have no choice but to work with the lows of the last 2 days in terms of an exit strategy. And the reason I say that, everybody, is if you are a bullish trader and believe there's more upside, great. But if you're waiting to be confirmed that you're wrong about the potential for continuation from here, we are right smack dab in the middle of it all. What do I mean by that? Well, here we are at about 21,470, right? Our downside, where a bull might say, you know what, under 20,940, I have no confidence that we are still in this uptrend. Well, that means that you're taking an exit strategy under this level, and an exit strategy on profit might be those prior highs, if not a breakout higher, right? The unfortunate aspect is that that's looks like about a 1-to-1 ratio, right? So if I'm a buyer here with an exit strategy under this, or a buyer here with an exit strategy over this, suddenly I'm risking $1 to make $1 in terms of a strategic approach to trading something. And one thing that traders try to avoid from an equity investment standpoint is try not to trade for $1 of risk to make $1. Why do I say that? Well, risk management and proper risk versus reward ratios can give the consistent trader, the individual who is trading day to day, week to week, you need the consistency of proper risk versus reward. Because listen, if you are right half the time, as is often the case for traders, active traders are right about half the time. What we don't want to do is simply find ourselves trading and spinning our wheels. So as an example, if I think about trading 10 times and I'm going to be right half the time, 10 trades, that means I'm going to make 5 profitable trades and I'm going to make 5 losing trades. And if I step into those trades with a willingness to risk $1 in order to make $1, well, 10 trades down the road, the likelihood is that I'm just break even. And my goal is not to break even, everybody. My goal is to be profitable here as traders. Otherwise, why would we be doing it? Don't get me wrong. I love trading. I want to be doing it, though, to be profitable. So if that's the case, we have to incorporate a disciplined process that's going to aid us in making money. And what we mean by that is I want to take better opportunities. I want lower risk for higher reward. And I want to also recognize that I'm going to take losses. I'm going to make trades that go against me. My key component to that is make those losers really small losers. We can have frequent losers, but we want them to stay small. And that's why something like that risk versus reward, when you look at those last 2 days, in order for the bullish trader to feel like they've set up a potential proper risk versus reward, it probably means a tight exit strategy working against the lows of the today and yesterday with a target of the prior highs. That could make sense from risk versus reward. If you're willing to risk all the way down to that last low at 20,800, well, now we've got a bit of a risk tolerant scenario that may not play out favorably over a longer window of time or a consistent number of your trades. So that's what we're working towards. We'll talk more about that as we get into some of these individual equities with you all today, because like I said, example trades are going to help me to illustrate that concept a little bit more clearly. Okay, NASDAQ, good start. Let's see if we can't get some continuation here. How about the small caps and the Russell actually providing a little leadership, up about 0.75% here today. Now, my draw tools, as you can see, are very detailed on the small caps. So let's bring it all together, everybody. Let's zoom on in to what's been happening since the summer. Now, we have talked about the stairs up and then that big elevator move to the downside. Let me eliminate this oval so we can see this a little more clearly. What do we have working in here? I'll bet a lot of you have a visual on this move and say, and have a pattern that you might be thinking about in this space. What is that pattern, everybody? Just out of curiosity, who's looking at it? Who's thinking the same thing that I might be in here? I'll put it in with some white lines. make it maybe stand out a little bit better for us here. So if this was our low and we were looking at it like this, and we then also kind of took the line off the peak and drew it like so, kind of resembles a bit of a bear flag, doesn't it, everybody? And if this is, in fact, a bear flag, what we need to see from that bear flag to break it, right, to be out of the bear flag scenario. Remember, bear flag is not a positive. Typically, a bear flag will break in the direction in which we entered that bear flag. We have rallied right into potential resistance on the Russell. Now, that certainly doesn't mean a breakdown is imminent, because again, while we have a level to pin ourselves against, the nice thing is, while bears might feel a little emboldened by this, they can set their proper risk versus reward by monitoring the 20-day moving average in orange, monitoring the downtrend line off the peaks, monitoring the horizontal resistance here. So if you were thinking bearishly, you might stay maintaining bearish sentiment as long as the Russell doesn't close over 2,300 or so. If you got closes over 2,300, the bear scenario might be eliminated altogether. But conversely, a rejection at the bear resistance zone here could prove to be opportunity for the short-term bearish small cap viewpoint here, right? It might lead you to think that you've got some opportunity further. Some traders would be patient, allow a rejection at the resistance zone, and look for a fall through the uptrend line to validate the potential breakdown of a bear flag. And that could be a significant move if you've deemed the move to have begun at the peak up here. Because one way that a trader may look at this, and again, always examples, nothing more than information, as you all know, but if we just looked at the distance that we moved off the peak, it was 11%, or a total of 269 points on the Russell. Almost, let's call it 270. So we could just move down from the uptrend line about that same distance. So I could just take that line and put it to, let's just say, right about there. And that kind of gives you an idea as to maybe where a true breakdown could go. Okay, it doesn't mean it has to. So let me revisit that. Let's just talk quickly. Measured move targets are never foregone conclusions. You've heard me say that many times. They are merely ways for the trader to validate or give them an estimation of what they want to shoot for should their scenario play out in the manner that they've deemed appropriate. So look, it certainly stands to reason that a breakdown could occur. If we broke the bear flag to the downside, where might we initially get a pause? Perhaps at the 200-day moving average right here, right? That would make sense. Get a little bit of a pause and maybe some continuation thereafter. But the ultimate level of measured move target for something like this, the fact that it just happens to coincide with these last lows, I can't help but call that out. I mean, I'm going to make that a rectangle here, everybody. That actually looks like a pretty good spot for a target. Now, needless to say, would that be fun? No, heck no. That would be downright terrible. We don't want to see that. We want to see the break right back through the red line, carry the Russell up, and basically take that bear flag that I've drawn in and say, yeah, Kev, you were totally wrong on this one. Let's hope that that's exactly what's going to happen here. That said, while we hope that that's what's going to happen, we are not positioning ourselves with trades based on hope. What we are going to do is position ourselves based on moves that absolutely occur, okay? Giving yourselves the if-then statement is what we want to do. So if the Russell breaks through 2,300 on a closing basis, what are you going to do as a result of that? What actions will you take? Is that a group that you're monitoring for your opportunity to trade? If not, great, then you can just set this one to the sidelines. Maybe you're watching other aspects for the breakdown and you're trading the bearish side of this. But the point is, know how you want to approach the trade, right? Look at it, give it a definition. Here's what I'm going to do if it's bullish. Here's what I'm going to do if it's bearish. And then give yourself the delineation of this is what will determine bearishness and this is what will determine bullishness. and I'm going to act only on those. Try to remove your emotions from the scenario. Hopefully that aids you in the process a little bit. Okay, so there is our brief broad market look. S&P 500, NASDAQ 100, Russell 2000. Let's take a look at the semis, and then we're going to get to some sector moves here as well. Now, yesterday, we talked about how good a move we'd had breaking this downtrend off the peak, right? Because even if I captured, instead of capturing these peaks, if I wanted to capture these, I'd still say yesterday's move was a nice breakout. But we also pointed out that we had some concerns about getting through this level, how this was a nice validation of a downtrend breakout, but not necessarily, as of yet, new short-term highs. As you can see, all we've done is made what I would probably posit are matching highs at this point. Now, we could hold on here, be fine as long. I think a lot of you who are more intermediate term in scope would like to just see the downtrend line be held, meaning everything that happens since we've broken the downtrend, as long as we stay above that 5180 or so, that probably gives bulls a little bit more confidence and enthusiasm in looking at these, at the pattern here as it relates to the semiconductors. So positive, sure. Shift better than we had previously with Monday's move yesterday. Yeah, wonderful. But by no means are we calling what we see here just yet, to be an outright breakout. We need to see some continuation. Got to trade through yesterday's high and ideally trade through the highs we made back in October, which would then give us an intermediate term new high. If we made this look, if this was a weekly chart, I think that stands out a little more clearly on the weekly here. So let's just cut all these lines, and I think it'll be a little more ominous. Look at where all of these tails are, everybody. See? So we've still, I think a lot of traders would say, this looks like resistance, doesn't it? And so if we are there and haven't busted through it, maybe we won't. And so what do we want to see? Close above it. Let's see if we can get into that 5,400 and above. I think would give bulls a little bit more confidence. Is that how you guys feel too? I mean, I tend to think you are all probably similar in nature. This is a pretty important level. As you can see, we have not really, for any extended period, traded above it for more, anything longer than a couple of days for the last 6 months. So I think that tells us a pretty important level to keep an eye on here. So 5,400 on the SOX. Plenty to keep an eye on there. Let's look at a sector action move, everybody. We'll see what's offering up some opportunity. Before I get to it, I want to see if I've got any good questions in the queue. Lots. I mean, obviously, Brent's going to manage a lot of this for us. Lots of good mornings. Love hearing the back and forth amongst you all. I know you all are here frequently, and the engagement between you individually is great. The engagement with us is great, but I just love seeing it. So good question here, Daniel, about risk versus reward. We talk about this, and I think Brent gets to it as well here. Yeah, $1 of risk for $2 of reward, maybe $1 of risk for $3 of reward. I'll talk a little more about that as we look at some of these individual equities in the news today. Like I said, we've got a few, and I want to use them as example trades because, on news-driven days, news events, upgrades, downgrades, they can be opportunity for you. So again, what we want to focus on is the process today. So when we start looking at those individual equities, don't take them as recommendations for your consideration, but rather recommendations of maybe a process by which you build your own trades. That's what I'd like to have you take away. So some of these stocks in the news today, let me give you a few on upgrades. Yesterday, we talked about financials. So let's look at the financials here. That's not the financials. There they are. We talked about the concern of having run ourselves into the confluence of the 20 and 50-day crossover here, where we're getting a shift to price action in various time frames, right? So we've got this 20-day moving average crossing to the downside. We've been working pretty well with the 20-day, very limited periods of time beneath the 20, and now we're beneath it for more than a month. So we're getting a little lengthy in that pullback and might not be a lot comfortable as it relates to financials. So heads up there. Seems like we're kind of banded below the 50 and 200 confluence here. Probably not feeling too bullish with regard to financials until we can clear that resistance spot, which looked like great support and now looks like pretty solid resistance, right? I mean, we've tested it for one day here, tested it and rejected at it for a second day. Yesterday, we couldn't even get into that ledge. So looks to me like we've got some work to do on financials. Energy's been improving, but also improving in what some traders might just say is a bit of a relief bounce. Where is the most recent support that could potentially be resistance? Anybody surprised to find that yesterday's peak kind of ran right to that level? I mean, I'm not. That's the way that technicals tend to work from time to time. So I'll just snap that line if it'll let me. There we go. So there looks like a level that we'd like to see the energy space get above. Let's change that to red, make that a dashed line. Now you've got a pretty clear short-term resistance zone to maybe build trades against for some of you. That might work out. As you can see, that longer range support is pretty obvious now at about 630. Good zone of support. 2 solid weeks there testing that. A one-day quick test that led to a wonderful extended rally, and then a matching low right here as well. So I think the support levels on energy seem to be pretty well founded. Good question here, Daniel. Yeah, that looks like a bear flag too, doesn't it? Is it getting a little lengthy on the upside? Perhaps not yet. Remember, you can get these bounce moves that can occur off of a sell like this, somewhere in the neighborhood of, depending on the strength of the bearishness, that bounce move could be maybe the 23% retracement, the 38% retracement as well. I think a lot of traders would say that if they want to stay bearish, they want to see that any bounce does not happen to be more than half or 50% of the sell-off move. So if we did a quick Fibonacci move on that for you, everybody, from the peak to the trough. So we are, oh, how about that? That 38% lines up almost perfectly with the horizontal resistance I drew in there for you. So that might be an important level. The 50% level is about 688. Notice the 50-day moving average down sloping into that. That could also be a potential note for some short-term traders. So keep an eye on that maybe on energy here. But of course, as it relates to energy, you all know you got to keep a close eye on all commentary relative to energy to feel like you've got a pretty good beat on things, right? I think that would make a lot of sense, specifically oil and its relationship with the sector. All right, next up, materials. Materials is broken down here. We've seen the U.S. dollar has been continuing to climb. Materials have been taking it on the chin. We've noted that both gold and silver have looked have kind of settled down after having rallied really aggressively. So this also doesn't look too fantastic from that standpoint. Obviously, we've got that we're well below the 20-day, well below major resistance, former support, now potential resistance. The 20-day probably feels a little too slow for some of you aggressive individuals, right? Because look, the likelihood is if I made that a 10-day moving average, let's see, I think I've got one in here. There it is. Nope, I'm going to have to adjust that and make that work. So let's just change it up here real fast from 20 to 10. I bet that the 10-day just flows right through it. And sure enough, we're right at it with our peak today. So, you know, that's going to be the first thing that needs to happen to shift the trend is to recapture the 10-day. As you can see, we've been below the 10-day now for 5 weeks. That's getting to a window where you might expect to see things shifting a little bit. But, you know, again, that just means maybe the materials are getting to a spot where you might see a relief bounce. But I say it as that specifically because after having broken significant support here in this case, that could easily become significant resistance for us moving forward. So any bounce might be a short-lived one is what I'm meaning to say. Okay, Moving on down the line here, industrials, kind of a breakdown as well. Not looking terribly healthy, needing to recapture a level of horizontal former support, potential resistance, 20-day moving average. We can note the crossover here as well. That's not ideal. So maybe we find our support in the vicinity of that 200-day moving average, but it does not appear to be ready to rock and roll once more, does it? I mean, it looks quite a bit different now over the last, say, 6 weeks versus the rally off of the August low, which looked a lot better, holding that 50-day along the way. So even industrials not looking wonderful. What about discretionary? Now, discretionary, we could still say we've got plenty to be optimistic about, because if I drew in this just looks like a standard bull flag, doesn't it? After a wonderful rally, whether you drew it from here to here or you drew it from this low, chances are we've not yet given back too much to say that this is ready to break down. But I think this all looks pretty good from a standpoint of the technicals on it. That doesn't mean it can't break down, obviously. There are some breaks in some of what's happening here. Notice how aggressive the move to the downside has been relative to the RSI. I think that just tells us the weakness in the selling is notable. But by no means is this at this point, not a bearish chart. It might not be ideal for the shorter term trader, being that we're below the 20-day for a week plus. But you intermediate term traders might say, yeah, that's all well and good, Kev. Look, we're holding the 50-day. We've not given back too much, and this looks still bullish in nature. What would a bullish trader be looking for some validation? They want to trade above the downtrend line of the flag, right? So in this case, you might need to see discretionary back up above the 20-day moving average to suggest that this is getting back in gear. Just doesn't appear to be there just yet. So a lot of sitting on our hands, I think, is what we're learning here so far, everybody. What about staples? Okay, we've talked a lot about how staples could be the benefactor of a market that starts to move away from the technology side of things, right? Some of that enthusiastic in buying up the risk on trade. Well, we've seen this really lag, and we're at a point where a lot of traders would say we need to see something happen here pretty quickly. So see if we can't get ourselves back up above that 200-day moving average here in the near term. We are in oversold conditions. That does not mean a bounce is imminent, though. Force price action to dictate what you're doing, right? Don't start basing decisions off of divergences and so forth. You can start to take little pieces here and there and say, yeah, I think a bounce is coming, but do try to stay small when given the opportunity, right? So let's see. Did we get that JOLTs out at the rollover at 8 o'clock Mountain? We sure did. Things are okay. So we see the VIX is popping. We see the S&P selling down a little bit. So take some note from that. We do have the jobs report on Friday as well. So we got plenty to keep our ear on as we move forward here. Okay, couple more quick hits. How am I doing on time? No, we're going to need to move on to the stocks in the news. So I want to run through a couple of upgrades for you guys so we can get a trade on here, an example trade opportunity. So I wanted to give you a couple of upgrades. Yesterday, we saw a couple of upgrades in the financial space as well. Bank of America today getting an upgrade out of HSBC and UBS. Bank of America to buy at HSBC. New target there at $50 a share. Upgraded at UBS to buy, previously at neutral. Target here from UBS is 53. That's up from 43. So that's a nice kick higher as well. Put a pin in that one, everybody, because when you look at where we are relative to the prior high, also kind of in the middle of the range, right? If we were looking at the last low as a support zone, we might not be set up ideally on Bank America. What about Snow? Snowflake was upgraded by Wells Fargo. Wells Fargo upgraded to overweight, previously at equal weight. New target here is $200, up from $150. Now, when you look at this one, everybody, if your target is the last high at around 188, let's say, then our last low could be the 50-day moving average at around 151. What are we looking at in terms of price? From 165 to 188, that's 23 of upside. And if we took the 50-day moving average, it's about 14, 15 of downside. So not quite a 1-to-2 ratio, but it's getting into that vicinity, right? So that might give you something for potential in if you get an opportunity to maybe be a buyer a little bit lower, you might feel a little more confident simply because your risk reward's better. Of course, if the risk reward's better, that means that maybe the trend doesn't look as good, right? Because now you're buying more likely near support and the 50-day moving average, but maybe not ideal in terms of the setup just yet. What about Carvana? And by the way, everybody, if you're wondering over here, take a look at the watch lists. These analyst upgrades and downgrades are available in the lovers and losers drop down. Upgrades and downgrades right here, along with the pre and post market movers. So if you're online ahead of market open, you can check these out and get a little indication as to what's happening. Good way to do that. So let's check out Carvana, make it a 7% move today nearly. And this is intriguing because of the level from which it's bouncing. And you've seen that yesterday didn't quite give you a hold, right? You didn't close above the high of the low day. If Friday was our low day, today's action could be the close above the high of the low day. Carvana was upgraded at RBC Capital, upgraded to outperform, previously at sector perform, new target here, 280 up from 270, stating that after Carvana's remarkable turnaround last year, RBC sees the controversial pullback in the shares as an opportunity. The firm's bottoms-up cohort analysis implies retail unit upside at Carvana, particularly as its supply improves. So if you like what you read, if you like what you see, opportunity, and again, we're going to do this from a very generic standpoint, everyone. If we looked and said that we think we can get back, maybe not 268, but what if we thought we could get to this range up here, right around, let's call it 260. Just nice and easy 260, okay? Put that right here. Put some numbers to all of this. Give us something to target. So if 260 is our target and we are trading at 200, really it means we could probably put on about 20 points of support or 20 points to the downside for an exit strategy and be okay. Some traders would say as long as we hold a level of intraday price action on a day like today, they might feel confident with that, right? So in looking at this, everyone, what if we took our opportunity for an example trade based on a couple of key components? One, we have an upgrade. We have a prior high at 260. We have a recent low at, let's call it 175. Okay. 175. Let me duplicate my numbers. There we go. All right. So 175 for an approximate exit, 260 for an approximate exit, entry at 200, risking perhaps 25 to the downside to make 60 to the upside. Now, that's not a perfect 1-to-3 ratio, but it is better than 1-to-2. And for a lot of traders, that's going to be sufficient. So let me just give you that one more time. I want to talk about that very briefly because I only got about 5 minutes to go with you, and I want to get this example trade in. But I want to reiterate the importance of the 1-to-3 or at least a 1-to-2 ratio and why this can work. Okay, so a couple of key details. We said it earlier that the average trader is right about half the time. So think of your scenario in trading as a 10-trade basis. And if each trade you make, you are going to either lose $1 or make $2 as an example. Well, then you've got to limit your risk properly. Now, if we are right half the time and wrong half the time, okay, 5 trades, we take a $1 loss, and 5 trades, we take a $2 gain. Well, after those 10 trades, we're positive, right? So 5 wins is plus 10 at $2 each, plus 10. And then our 5 losses at $1 each is minus 5. So that's a net of plus 5. So 10 trades down the road, we're right half the time, and we are making money. We're plus 5. That's a strategy we can get behind. But we're also needing to recognize that while we can be right half the time over 10 trades, there's going to be instances where we're wrong more than half the time. And that's where that 1-to-3 ratio can really benefit the trader who's willing to stick to such a process. So imagine being right as few as 3 out of 10 times. And in my 1-to-2 ratio scenario, if you're right only 3 out of 10 times, then your 3 right trades bring you a plus 6, and your 7 wrong trades bring you a minus 7. $1 loss for each of your 7. So here, 10 trades down the road, and because your risk reward is only $1 to make 2, you're not profitable at only being right 3 out of 10 times. But if you kick up your risk reward ratio to a risk of $1 to make 3, well, you can be right as few as 3 out of 10 times and still profitable, right? Because your 3 trades, you're making $3 each. That's plus 9. And your 7 wrong trades, you're losing $1 each. That's minus 7. 10 trades down the road, you're plus 2. Now, that's not ideal. That's not what we're striving for, but you're not losing capital. And that is such a key component. Yes, we trade to make money, but we also have to incorporate the knowledge that we can't risk our capital to do just that, right? We can risk a certain amount of capital, but we don't want to overdo it. Okay, that's why that 1-to-3 risk ratio can work out for a trader who is deploying that consistently. So for our purposes today, let's go and check, just see where we are on the intraday basis. We started hot. Do I have my pivot points in here? I do not. Let's just add those real quick. See if so we probably gapped on these pivots today. I want to make sure that, all right, that looks good, looks good. So here is our pivot. We gapped. Okay, so some of you might choose, if you're a real short-term trader, I could see utilizing this R1 as support for the day because that's where we gapped to today. And some traders would say that that becomes short-term support. That can make sense, but a lot of you are going to be a little longer range, okay? So we're just going to incorporate the numbers that we have done so with today. We've looked at today. So it's going to be very simple. It's going to be a buy with custom with an OCO bracket. One cancels other. And we're just going to buy 25 just so we can get some exposure. Okay, so 25 shares at market will be our entrance. And then we're going to do an exit strategy at the 260 level on a good till canceled basis. Make that good till canceled. There we go. Or a stop at the low there was 175.42. Yeah, so we'll go under 175. So it'll say basically if we make a new short-term low, we don't want to be in this trade any longer. Now, again, I want to reiterate, I'm not suggesting that this is the way that you have to use these numbers and build the trade this way. What I am suggesting is to set the levels that make sense to you. Does 260 make sense? Does 268 make sense? Does the 175 low make sense? Or would a trader say, you know what, I'd rather Kevin work with the 150 or 155 200-day moving average, which could be a very different conversation. But my point is very simple. I want you to focus on process, not the specifics we've built the trade with necessarily, okay? So buying at market, exit strategy to sell at either 260 or 175. My reminder to you is only one side of these trades can execute, right? We're going to buy immediately and the sell at the limit or the sell at the stop. The best part is, everyone, as a trader, I can just step away from this, right? Because my trade is well defined and I have my risk factor to the upside, my goal, my target zone, and my risk factor to the downside. Now, last note, remember, when I incorporate a stop order, that is a market order once it triggers. I can't guarantee my exit price. So if I get triggered, particularly in a gap move, if we closed above 175 but opened at 155 the next day, 155 is going to be pretty close to my execution. Unfortunately, not the 175 approximation that I'm hoping for with my traditional stop. Okay? So very basic order, very basic approach, but I wanted to make sure that we built a trade in this new and otherwise brand new account today, everybody. So there we go. I want to thank you all for being here. Plenty of more to come from us. I know it's a busy market day. We've already seen the market react unfavorably to that JOLTs report. Keep it tuned right here to the Schwab YouTube coaching channel. Follow Brent and me on X. Hit that thumbs up button down below and make sure that you're subscribed to the Schwab YouTube coaching channel. Thank you all for being here today. Loved seeing you here. Be sure to catch up again tomorrow when I've got Brent as my co-host. So have a great Tuesday, everybody. We look forward to seeing you again real soon.